Hey everybody, Chuck Barone here. Wednesday, March the 1st, 2023. Closing in on the last month here of the first quarter, and we're off and running with the crazy. Doesn't take long, does it, guys? I gotta tell you, I've been watching these markets. I'm an old friggin' dinosaur now. I've been watching these markets since the early 80s. And I gotta say, this is all crazy new stuff. I mean, I lived through the past inflation. I watched how the world reacted to it. I watched the markets. I've tried to learn as much as I could for a young guy, And I think that the people who were supposed to have learned something from this and the professionals didn't so much because, wow, it's just, they're all over the place. It changes every day. Anyway, let's get all into this. But before we do, I just want to welcome everybody to the show. Thank you guys for your support as always. We appreciate what you guys do, your likes and comments and questions and shares. You guys are the reason we do this every day. We want you to know we appreciate you. Markets today. Well, not much today, guys, right? A blah day in the stock market for sure. Mixed bag. The Dow actually eking out a small gain, 5 points, with the S&P down 18, NASDAQ down 76. You remember when just a week or two ago when the market was going to rally again and everybody was jumping back into the super speculative stuff on the NASDAQ? Well, now they're giving all that back as the sentiment turns negative, and the market, it's just so funny how they act. It's almost like a child, right? So it's like, if it's good, it's going to be good forever. If it's bad, it's going to be bad forever. Crazy times, man. I mean that. So anyway, stocks, not great. And then truthfully, guys, the trend is down. This stock market can fight the Fed all it wants. It's going to lose this fight, okay? Bond market today, yields up, bonds selling off. 10-year up 7 basis points, 3.995, okay? So it's just like pretty much as close as it can get to 4% of the 10-year. The 2-year at 4.88%, up 8 basis points. So now you look at these yields. So you can still see the inversion here, right? When you got the 2-year at 4.88 up here, and the 10-year at 3.99 down here, they got an 89 basis point inversion. Usually it's going to be 2-year down here, 10-year up here, right? But anyway, so that inversion is giving us a signal there's bad economic times coming ahead. And they tell us that the wider the inversion, typically the more severe the downturn is going to be. I think that it actually got to 114 basis points once in the past. So we're moving toward record inversion here. The signals are negative for the market, guys. Let's just say what it is, right? I mean, there'll be these bear market rallies. There'll be these head fakes where people are going to think the worst is over, but it just isn't, man. Okay, and it's not going to be for a while. Now, I'm not saying the stock market is necessarily going to go down forever. I'm not saying there's a crash coming, because there probably isn't a crash coming. I just think it's going to be death by pinprick, man, where you just keep getting these little dribs and dribs of bad news. The sentiment builds down. There's a lot of reasons to like stocks right now, but the main reason to not like them is because of what the Fed's plans are for this economy, guys. We've talked about it before. So anyway, bond yields up. More cost to all the people in debt in this country. More money coming in for savers, though. So if you've been listening to us and stashing some money, look at these rates, man. Look at these yields you can get. More than 5% on a 6-month T-bill, guys. I mean, that's pretty soon. Those are going to be bank rates. And, people will finally be rewarded for saving money and punished for borrowing it, which is like the normal way it's supposed to work. It just hasn't for the last 20 years or so. Well, now it's time to pay the band, guys. The party's over. So hopefully you guys have been heeding the direction and the advice we've been given. The dollar today down 104.45 on the index. Still strong, guys. I mean, it's in this up or down, 40 basis points on the index, not really meaning anything. The dollar's still champ. The world currencies are trying their best to catch up, but now with the Fed signaling more rate increases than were baked into the cake, dollar rallies. With the dollar down today, metals up, yay. Gold and silver have a little bit of a rally today. Gold up $10.60 per ounce at 1837. Silver up 74 cents, $20.96 per ounce. So metals, I'm telling you guys, these are going to rally. You know, you're going to see 2,000 gold. You're going to see $25 silver. The money is, I believe the money is there. It just needs a reason to move, and the dollar coming down is going to be that main reason. Oil today up small. West Texas Intermediate at $77.73, up 68 cents per barrel. Still in that trough, $75 to $80. Means gas prices are going to probably be stable around where they are right now. Although, you know, with the greedflation and these friggin' oil companies, well, we'll see. But anyway, oil holding steady. Bitcoin today, not much. Up day for Bitcoin. Small gain, $181, 23,417. And that's interesting because I was reading in the journal this morning, another FTX executive pled guilty to fraud. That's the third top guy. This whole thing's going to go down in flames, man. And Bitcoin, however, and most cryptos, holding up in the face of it. News you guys need today. Well, the big news of the day today is this consumer sentiment. The report comes out, the index falling, oh crap, 102.9 from 106. So consumers turning a little bit more negative. The analysts had actually expected it to rise to 108.5. So not a good result. When you're expecting it to go up 2 points and it goes down, you know, more than, it goes down 3 and change, not good for consumer sentiment. Consumers shying away now, saying they're going to be shying away for the next 6 months for most big ticket items, you know, home appliances, air conditioning, and, you know, home repairs, major ones, new cars and trucks. This is the sign, guys, the signal, right? We know our economy is 70% consumers. So this is the signal. Now the consumer sentiment is changing. We've been seeing sales and, you know, earnings and consumer spending still staying sky high and growing. This is the signal now that consumers are getting a sniff of the coffee and coming out under the ether. Hopefully they've been listening to our show and are banking some of their money, because I'm telling you, down the road, everything you want today will be cheaper. Go figure. So, you know, as much as they're freaking out about inflation, I'm telling you, deflation's coming, especially. Now, I'm not talking about eggs. I'm talking about Rolex watches. I'm talking about fancy cars. I'm talking about the luxury items that people have been paying premiums for. It's all going to go down, man. People don't want it anymore. Cash is more valuable than stuff for a change, and that's as it should be. So now, consumers shying away. Now, what's been keeping the consumers going is this jobs, and income growth. We'll see if that goes on. Now, this was interesting, though, because the University of Michigan Index, which also measures consumer sentiment, just a week ago or so hit a 14-month high. Now, that's a pretty reliable one. This latest here, not quite as well known as the University of Michigan's poll or index is. So one of these guys is really, really wrong, right? Unless sentiment really changed over the last week, and it could have, because look what happened to the stock market last week, right? But anyway, consumers, confused as I am and as we are with the state of the world right now, getting whipsawed all over the place. One day is good, the next day is hunkered down, the world is coming to an end. The smart consumer is still spending money. He's just being careful and thoughtful about what he's spending that money on. More news today. You know, I've told you guys a million times to discount what you hear from these Fed knuckleheads out there today. We've had them going, well, you know, they're trying to send the message, and this is good, actually, about what the Fed's basic macro plan is. raising rates higher, keeping them higher for longer, staying the course until they get this inflation numbers down to where they want them. That's been the old message going since the Fed started raising rates last year. Well, today we get Neil Cash and Carey coming out again, and this knucklehead now saying that, well, I'm open to raising rates 50 basis points coming up in March, and I think that I'm going to have to revise what I believe is the terminal rate from, this is paraphrasing him, of course, from 5.4%, which he saw as the peak, higher. Some now Bank of America predicting 6% of the overnight rate. We're at 4.6 right now. Basically, Neil Cash Carey saying that you can expect another full point of increases on the overnight rate, or he would support that. So, like I've been saying, guys, this inflation fight, the last time we saw inflation like this, took them 10 years to bring it under control. And we had to have a massive recession with 10% unemployment and interest rates at 18%. Okay? Now, I've been talking to you guys about this for a long time since this inflation. We've been talking about inflation on this show. How the inflation rate, to bring it down, you have to get the interest rates higher than the actual inflation rate, right? So we have our overnight rate here at 4.6. We got the inflation rate basically at 5.5. Okay, so now if you're listening to Neil Cash and Carey, the Fed planning on getting that Fed funds rate up to 5.6, which would actually be higher than today's rate of inflation if they can keep it from going up at all. I don't know if that 10 basis points is enough to really drive inflation down to 2%. Even if they get it to 6% and we have inflation at 5.5, I don't see that being enough to drive inflation down to 2%. So we're going to keep an eye on all this stuff. It's just going to be fascinating, guys, to see the real effects of these rate hikes and inflation. Now, it looked like we had a straight line down to 2%, had a little bit of an upset in January and February. Now, here we are in March, and I got a feeling we got another month of surprises coming. A couple quick things before we wrap things up today. I reading an article today. Our buddies in Congress, you know, the guys who love us and take care of us and are looking out for us and, you know, writing laws for the good of the American people and, you know, keeping their word and being honorable people and all that fun stuff. Now they're talking about raising the age for Social Security benefits to 70. Man, I don't know how these guys, you know, you have a contract, right? You go to work. You know, I started working very young. I've been paying into this system my whole life. They already screwed me once because the age for my maximum benefits went from 65 to 66 years, 10 months, essentially 67. Now they want to raise it to 70. What they're doing is aging people out of Social Security. Because there's a certain percentage of people that are going to die and are never going to collect a penny. They're going to pay it in their whole lives, and they're going to leave the money there because it's already been they can't leave money that's already been previously spent. But this is a pretty naked scam. I mean, I understand Social Security's in trouble. I get that, and they're talking about this insolvency. I just wonder how insolvent Social Security would be if the government hadn't raided those funds since, you know, the late 60s and to this day. And the money is actually there and had been accumulating and been allowed to be properly invested, not invested in treasuries only that are under market rates. This has been a play toy for the government forever. Of basic trillions of dollars in slush fund money they can spend. And now they want to stick it to the people who paid that money. Guys like me. Guys like you. Want to make an old fart like me unhappy? break your word on a deal that I've already been involved with for almost 50 years. And I've been paying for almost 50 years. Now they want to change the deal. Well, I can't go get my 50 years back, can I, guys? So there you go with our wonderful schmucks in government treating us like crap as usual. Mortgage applications hit a 28-year low. Now, I've been telling you guys that real estate's toast. It's been coming down excruciatingly slowly. But the jury's in, man. 28-year low. So we're going back to Bill Clinton president, okay? The beginning of Bill Clinton president. It's just a catastrophe in the real estate industry. And with the Fed signaling more rate increases, higher rates for longer, I tell you now, real estate prices will continue to come down. They've been incredibly buoyant, man. They've been fighting gravity, defying gravity. I think we're going to run into this, this Wile E. Coyote moment where they're running off the cliff and they're going to keep running. And then one of these days they're going to realize that there's nothing underneath them. And well, we all know how that ends with a little cloud, right? But here's now, this is a couple last things to wrap it up. Crazy stuff. Read the local paper every morning. Vegas, Clark County, hit $1 billion in gaming wins again last month for February. 23 consecutive months of $1 billion plus wins at the tables here in Vegas. So I don't know what kind of recession we're really having when people are still flocking to Vegas and blowing $1 billion a month on gambling. That doesn't even include the hotels and the food and the shows and friggin' everything else that goes with Vegas. $1 billion a month. And actually $1.2 billion this past month. So Vegas is rocking and rolling, just not Vegas real estate. And finally, this one made me laugh, and hopefully it'll make you laugh too. These in Vegas shows are huge. Every hotel has big showrooms. We got all the Cirque shows. We got resorts and MGM and all these places with big stars, big name stars in entertainment, the biggest in the world. Well, tickets in Vegas are getting pretty expensive. Some of these shows are, if you want a good seat, you can pay $500 or more for a ticket. So now, Ticketmaster and other ticket brokers are offering to finance show tickets. Okay, check it out. So you go on and it tells you the ticket is $200 per person or $14.95 a month. Oh my God, man. Okay, so people can blow $1 billion gambling, but they need to finance their show tickets. Guys, I've been telling you, they want to make us all wait, slaves to debt. Slaves, payment slaves is what I call it, right? Where basically your existence is to get up, go to work, make money to make payments when you get paid. And this is further signs of the insanity of our corporate overlords. They really believe that. Now, I don't know how many people are financing show tickets. But if you're watching this show and you would even consider that, please reconsider, okay? If you can't afford to pay for your show tickets, then don't buy them, man. Don't finance show tickets, okay? Anyway, guys, I have just an absurdity that I wanted to share with you guys. And that's it for today. A crazy day on the markets. Tomorrow we know is a huge day. We got employment numbers. We got consumer spending. We got consumer income. It's going to be a fun day tomorrow. So we'll be back with all the details, keeping you guys informed, the news you need. As always, again, we appreciate your support. Looking forward to tomorrow's show. Until then, guys, take care. Thanks.